Thank you very much, Lisa, and good afternoon or good morning, everyone, depending on where you are in this huge country of ours here. And hopefully you're nice indoors, warm. And I know some of you are like myself, waiting for an oncoming storm here. So a couple of things as I go through this session here, folks. I know Lisa's activated the Q&A box. So, if you have a question, please feel free to put it in the box. Lisa's been kind enough to guarantee me that she will be monitoring that. There might be some points throughout the session that I'll just do a check-in to ask some questions, or, hopefully I'll do my best to make sure there's some time here at the end. And there will be a quiz for those of you in Quebec that you have to subscribe to and participate, but Lisa will make sure all of that is available to you. So again, let's start with our session today. Now, I just want to be upfront about this. And, this is going to be a little bit different, perhaps, than what you're accustomed to, in that it's not going to be about, product or technical. This is different. It's less on the IQ analytical side of the brain, but more on the EQ side of the brain. So I'm going to ask you to keep an open mindset here. And it's appropriate that it's on the EQ side of the brain because we are talking about behavior. And, behavior focused advice really is about the human side of advice. And that's what we're going to focus on today. You know as well as I do, if not better than I do, that when it comes to giving your advice, it's always finding that delicate balance between the art and the science of, offering the structure, the processes here. And, as advisors, you have many things to look after. And I know that you need to manage for multiple dimensions of risk, both within the portfolio and outside of the portfolio. And seeing this is more on the behavior aspect, I'm going to focus on some areas that is outside of the portfolio, right? I'm not going to spend much time here on market risk. You do enough of that, and there's enough been spoken about that. But clearly, as you've seen over the past year and a half or so, this thing called inflation that we all forgot about has come back here. And every time I see this, and I always say the same thing, it reminds me, I'm dating myself here, folks, and some of you might be, in my age group and recall back in the 80s or perhaps early 90s, there were a lot of those horror movies and Halloween and Friday the 13th and whatnot. And I'll never forget that one lead character, Jason or Michael, right? The boogeyman. Just when you thought they were dead, they keep coming right back up. And that's a little bit like inflation. We've completely forgot about it, but it is key. More and more clients are asking you about that. And that's something that you always have to factor in when you've done your retirement planning, when you've done your financial planning with your clients. For myself, when it pertains to, health and longevity risk, really, this to me is the why people decide to partner with. This is why they want to work with you, right? They have challenges, they have objectives, they want to preserve their income, they want to guarantee an income, assets, whatever the situation, right? It is complicated, and they're coming to you looking for that support and that advice, and you need to make them aware of the challenges in that. And the other thing that perhaps is less obvious to your clients, but perhaps not so much to you, is managing their behavior risk. Now, some of you might be saying, Angelo, I didn't join this business industry to become a therapist, a psychologist here. I agree with you. I understand that. But let me just share a simple anecdote here with you. And I would like to think that most of you, if not all of you, have taken a flight at some point in your lifetime here. When you're in that seat, sitting there and the flight's going smoothly, at some point, the fasten the seatbelt sign may come up, and a member of the crew will say, your passengers, notice the seatbelt fasten sign has come up. Please remain seated, yada, yada, and all of that. We'll get you through this little rough patch as best as we can. What do? Well, last I checked, nobody gets up and starts knocking on the cockpit door, and giving the pilot some advice, how fast they should go, how slow, why aren't they gone lower or quick. Forgive me, I don't know all the aeronautical language here, but you see where I'm going with this. What do? We sit. We respect the process. We respect the guidelines. We trust their training. We have confidence that they'll get us through this. Yet when it comes to the area of investments, and I've been at this for over 30 years, folks, as some of you have been at this for quite some time. When it comes to investments, everybody seems to have an opinion and telling you what to do, how it should be done, how you should do it, and so on here. And that is why I often ask advisors, when I have the conversation with them, are you a manager of investments or a manager of investors? Now, folks, understand, I'm not critiquing or criticizing your qualities and your technical capabilities. You may be a CFP, you may CFA, you may work on to having your CIM, whatever. I fully trust that you have your technical proficiency and competencies. But like it or not, at the beginning of our careers, we are given very little, if any, training on how to manage people. We're given technical product training, Yes, we're getting some sales training and maybe there's some behavior management there. But for many of us, it's a skill set gap in this industry. And as we grow and build our business, we gain the experience. We kind of, in spite of ourselves, learn and start to realize how we should do things better here. So what are the three key things I'd like you to keep in mind today that we'll talk about? One, it's understanding and identifying the behavior gap, what it is, and why people behave the way they do. I will talk about that. The second takeaway for you is really understanding how to better communicate your human advantage. Now, there is an advantage, but we just have to make sure we're communicating consistently and in a proper manner to our clients and to our prospective clients. And the last thing we'll take away here today is look at some investor profiles, see what some of their bias are, and give you some quick hits, some quick exercise or quick resources that you can use to help you or help them, I should say, overcome some of the decisions that are going to be taken, which as many of you may have experienced over this past year or two, or if it's not your first rodeo in terms of seeing market volatility, you've had to deal with and manage. Okay, let's get going with this. And I'd like to start right away with the first part of the session here today, the behavior gap. What do we mean when we talk about the behavior gap? And more importantly, if this is happening, why do investors behave the way they do, particularly in volatile markets? Now, there's some interesting data from a firm, out of the US called Dalbar, and they've been doing research for many years and gathering data on market performance and actually investor performance. And what you see here is the rate of return of the S&P 500 in the US for 30 years. And all the data in this presentation, by the way, is ending December 31st, 2021. So very, very, very recent here. And what you see next to it is the performance of the average equity US equity investor at 7.13%. There is the gap. The average equity investor has underperformed on average by 3.5%. Folks, that is over 30 years. Well, that's a long time frame, I know. But think of the work you're doing with clients, retirement planning. You might be working with clients for the next 20, 30. That's a significant amount of money that's lost year after year. Okay? And that's important to recognize here. Now, I'm not saying all your clients do this, but why is this happening? Particularly when we hear consistently firms out there saying, hey, you know what? Come here. It's going to cost you so much less. You'll retire 30, 40% wealthier. You know which ones I'm referring to here, right? Constant pressure, constant media and noise out there telling your clients, yeah, don't worry about dealing with an advisor. You don't need an advisor. Come here. It costs much less. You'll do better. And yet we still keep seeing this. And particularly also since traditional finance, I'm not going to make this a technical presentation here, but big picture speaking, in traditional finance, be it Markowitz theory or even maybe capital asset pricing model, we are often told that the investor has access to all the necessary information to make rational decisions. But what we have seen over the last couple of decades gain in popularity is a number of researchers, the likes of Daniel Kahneman, Meyer Statman, Richard Thaler of Leighton. You can find great research papers from these individuals, folks, that they've demonstrated, you know what? No, investors don't act rationally most of the time. In fact, there are serious and numerous examples, clearly defined examples, how their misjudgment and how they interpret information ends up penalizing their investment decisions. So what we have more and more today was become more popular is what we call this idea of behavioral finance. And that's what we're addressing today. And really, it's all about the application of psychology, or rather the marriage of psychology to traditional finance, which is what we call behavioral finance today, to better understand why people behave the way they do, as opposed to how they should be behaving. We don't want to look in the theory. Let's look at what's happening here. Okay, so why is that happening? Why do some of our clients behave the way they do? And in order to understand that, we need to take a step back and understand, well, how do we as humans take decisions? Now, I'm not a psychologist nor a neurologist, but there's ample information out there that I can give an educated explanation to you here. I think you will all agree the primary purpose for the brain is survival. Anytime we face a new situation for the first time, something that's completely different, what does the brain do? It's consistently in survival mode. So it's fight or flight. Okay, I need to figure out if I need to run away to save myself or stay here and fight to make sure I survive. That's the reptilian brain. That's been developed for millions and millions of years, the instinct. Once we overcome that, so Angelo says he'd like to exercise or go for a jog or whatnot. And of course, what happens the first 5 minutes, I'm running and my mind is telling me, what are you doing here? You should be parking your butt back home on your lazy boy, because it's not normal. It's about survival, and it wants to shut the system down. But if we get past that, okay, if we're able to push through that, then the other aspect of the brain comes in. And this is what we call the limbic system, the smaller portion of the brain at the back of the brain. And this is where we hear the voices, the excuses, all those reasons why we shouldn't be doing this. It's difficult, it's hard, it's too time consuming, all the excuses why we should or should be doing this here. And if we're able to get past that and manage that, we have what we call the prefrontal cortex, or the neocortex, which is the larger portion of the brain. This is the analytical part of the brain, yet the least developed part of the brain. And what's important to know, and different studies will show different numbers, but many studies from the likes of Daniel Kahneman, who's a father in all this, and I referenced his name earlier, will say that as much as 90%, that's 90% of our decisions are taken primarily based with emotions. Okay, I know some of you think, hey, no, I'm analytical. Yes, some of you are more analytical than emotional. I get that, right? But again, when you're looking at different factors, emotions do have a serious impact on how we interpret and take decisions here. But okay, that's how the brain is working and how it doesn't process, but that's the instinctive reaction. But how does it process information? And that really is attributable to our biases. Now, a bias, I think you'll agree with me, is really an unconscious filter in terms of, filtering out the information that we receive. Every day we're bombarded with tons and tons of information. And how do we interpret that information to take a decision here? And really those biases are created, during our childhood, stories we hear from our parents, grandparents, relatives, our experiences. And really what comes out of science is that there are basically two primary biases. One is what we call cognitive biases. Now, this, as you see on the screen, is really caused by defective thinking or faulty calculation, or even taking shortcuts, right? Where we're looking at the short-term benefit and not the long-term benefit. But a lot of this is these cognitive biases are due to our beliefs, or rather, I should say, the perseverance of our beliefs. And folks, what better example than two easy examples I can give to you. And Angelo, not saying one is right or wrong. Okay, I'm just stating what's out there. If you look to our neighbors to the south, right, the continued gun debate. Now, regardless of events, and unfortunately, we've seen some recently, regardless of legislation, no matter what happens, okay, you will always see two firmly entrenched camps in the for or against gun control and whatnot. Again, I'm not suggesting one is right, one is not, but this to show you that example. And if you even look on a global basis, right, the global health pandemic that happened over the last couple of years, you had the, anti-vaccine or pro-vaccine and different regulation. Again, not saying one is right or the other, but clearly because of the beliefs and how we process that, we stand true to that and we say there is no other way, and this is the only way to do that, whether you agree or disagree. The other type of bias, what we call emotional biases, and this is more from impulses, intuitions and feelings here. So, when you have, think about what we just said here. When you have events that occur and suddenly we're faced with a situation for the first time, think how the brain is thinking about survival. Then you've got these biases, cognitive and even emotional, that are getting affected or being stressed and influence our decision-making process. So when you've got these external factors, what you would assume to be, or we think to be, perfectly rational human beings don't always seem to act in the most rational manner. And a great example that's fairly recent I can share with you, recall back in the spring of 2020, when the global health pandemic first came to fruition. What did we see on a regular basis on TV and the news and whatever, YouTube or whatever, Instagram or TikTok? We saw reports of people fighting in the grocery store for toilet paper. So I'm going to play this little video clip here. It could have happened anywhere in the world. It just happens to be in Australia. And I kept this because of what the Australian authority says at the end. And I want you to pay close attention to what she says at the end. But again, this is something we saw typically going on here. So the quality isn't the greatest of the video, but it's more the messaging. And I think you'll get it. Here we go.
The incident, one of several at Australian supermarkets, as desperation for toilet paper reaches irrational levels.
Everybody please stay calm and be rational. We have everything we need.
Okay, so two things. First, I don't know if I was going to put money on who to win that battle. I will never bet on the old woman winning and getting that battle and getting the toilet paper. But jokes aside, folks, look at what she just said. We have everything we need. Everybody stay calm and be rational. No, based on what I just shared with you, think about it. Our brains are not necessarily hardwired to make the most optimal decision. Think of what we just said, right? Our brains are not developed enough to understand the long-term implications of the decisions we're taking today. And that's why we often take shortcuts, right? It's about now, it's about survival and immediate benefits. Think of the work that you do: financial planning, estate planning, retirement planning. If I'm your client, when will I experience those benefits? That's 10, 15, 20, 30 years into the future here. So whatever decision I'm taking to sell something, to get out of something, to make changes, I'm not thinking about somewhere down the line. I'm just thinking of here and now. And I know that's something that you know, but that's what makes it even more difficult in terms of what you do. But understand what's happening in clients' minds, and that can help you better manage that behavior. So that when you see something like this, and I know for many of you, you've not experienced, this is not your first experience in volatile markets. And, some of you, many of you may have seen this slide, I should say, in different shape or form and different presentations and providers over the years. I like to call this, the FOMO FUD cycle. Yes, it's about emotions, but really it's about, as you can see, the fear of missing out, got to be there, got to chase, to suddenly followed by fear, uncertainty, and total despair here. And that's really the emotional cycle of investing that many of your clients live in, that you have to manage here. Every time I see this slide, I'm reminded of one key phrase that was shared. Some of you might know the portfolio manager, Peter Lynch, successful portfolio manager in the United States back in the 80s and the 90s, and written several books and been in many interviews here. I don't think he manages money anymore for a number of years. But Peter Lynch, well-respected portfolio manager at the time, said, or there's a statement attributable to him, says, you know what? The most important human organ, when it pertains to investing, is not the brain. It is the stomach. In other words, what he's simply trying to say, folks, investors, if you can't stomach all that's happened, you should not be fully invested. You should not be looking at securities, and you should not be going at this alone. You should be working with somebody here. But, that's enough of theory of talking about what's happening. What does it look like in the real world? What does it look like in the practical world? And there's an interesting study that was done from SCI in the fall of 2019. So before COVID hit, before this global health pandemic. And it's interesting because what they wanted to find out from advisors, what they thought their clients would do when faced with volatility. And they asked the same questions of those clients. How will you act or behave when you're going to have to go through a volatile market? And so I just took some of the highlights here. So it's interesting what we see here, because what we think our clients do and what they actually do, well, I'll leave it up to you to decide here. So let's look at this here. Many advisors said that clients would be taking a wait and see approach. What do those same clients say? This is no, we're more likely, and the importance of the need to make changes to the portfolio. Almost 100% of advisors believe their clients wouldn't deviate from financial plan. After all, that's the financial plan that they agreed to. They said yes, they participated. I saw them nodding their head. They signed it. What do most clients say they do? Want to move the money. That's their intention. Now, whether they did or didn't when the volatility hit, we don't know. But that's what's going through their mind. They want to move. And it's a reaction. They won't even call their advisors what they're thinking. And more than half the advisors thought that those families that had a buy and hold philosophy, which many of us, work with our clients and they say they have the philosophy, they wouldn't make change to the portfolios. But what do we see? Nearly half of those clients said, nah, they were likely going to make change to their portfolio. So what we're clearly seeing here is somewhat of an Achilles heel, right? Do we actually know our clients? And I know some of you may have thought, well, I didn't get phone calls during the last volatility right now. Just because you're not getting phone calls doesn't mean they're not thinking of this. Understand all the noise that they're faced with. Everything that's happening out there is inundating with information and causing stress here. And so, again, it could be an Achilles heel for many of us, because think of what we do. We expect our clients to take decisions on complex matters that will have an impact in the future, objectives and goals and decisions. We never really true what they're thinking or how they will act. And that's true, right? You don't know until someone is actually faced with a situation. So that's why I'm suggesting to you, refuse to be surprised. When you think clients are acting irrational or they're surprising you, do not be surprised. Think of everything we just shared. In fact, it might even be the norms because of the stress of these events that are taking on people's emotions. Emotions overtake their analytical skills. So I often say, refuse to be surprised. And that's why I keep putting this slide up in this presentation. Recall when you were young, playing with friends, and mom would yell, stop running around with scissors in your hands. You're going to hurt yourself. Sometimes for some of us, some of our clients are like little kids with scissors in their hands. They will end up hurting themselves by pulling out, complaining they need to chase certain stocks or certain securities or whatnot. They could end up hurting themselves. So I'm asking you to keep that mindset open in that aspect there. Okay, I think I've said enough about understanding the behavior gap and why people do. I don't notice any questions here in the Q&A box. So Lisa, I'm going to keep going through for this. But folks, again, if there's anything, don't hesitate to put it there. Lisa knows she can interrupt me at the opportune time. If not, we'll try and get to some questions at the end. Okay, folks. Let's get into the next part. So you understand now what's happening to people and how they're thinking and processing information. How do we manage that? Well, there's a number of things we can do. And I'd like to start with something that really is a long-term process. I invite you to make this part of your process throughout your relationship and journey with your clients here, is to really ensure you find ways to communicate the value of what you do, the human advantage. You may know this, but how do we communicate that message and get it out to clients? And you may think it's not important, but think of it this way. If I ask you, I will ask you, I won't expect an answer here in virtual, but do your clients remember everything you've done for them? And I'm pretty sure if we're all of us, 200, 250 of us in the same room, I get most people nodding their heads no. Right, because they're busy with their own lives. That's why they come to you. They forget everything you've done for them and continue to do. We need to find ways to remind them. Why? Because you'll see it is critical. The value of what you bring to the table, you know this, but we want to make them aware, prospective clients and existing clients here. Now, a number of you have seen some studies from Vanguard or Russell Investments over the last few years, where they've tried to determine the value of what you bring to the table. How do I get a numerical value of what you do in terms of performance of the client's portfolio? And they've got some proprietary ways of calculating that, from asset allocation, rebalancing, customization, tax efficient investing, and a few other criteria. And one of the things they do include there is the behavioral coaching that you do. And so in this recent study from Russell back in December 31st of 2021, what they found is that you bring about 3.85% return value to your clients. But as you can see, 1.93%, half of that is the value of the behavioral coaching that you do, is the managing of your clients' emotions. And folks, I've seen these studies for several years now, and it always ranges anywhere from 40 to 50% of the value you bring is all the managing of the client's emotions and behaviors. You are there during the tough times and periods. Now, we can't really go out and say, look, client, I give you 1.93%. No, we can't do that, and that's not a right way to communicate. How do we do that? This is where we get into the weeds here and some examples. Let's go back for a moment to what I shared earlier. Think how people process information. Think about the biases. You don't know me. If you meet me for the first time, or perhaps I'm your client for a few years, do you really know how I process information? Am I more analytical, cognitive? I need data. Or do I need more visuals, right? Stories, pictures, engagement. So you need to find ways to communicate your message to tap into both sides of my brain possible, cognitive and emotional. And as you do that, you'll get a sense of, hey, Angelo responds more to perhaps something that is a visual, something that is a story on the emotion. Another client might be a little bit more cognitive. So it helps you adapt and understand, okay, if I'm going to give them information or if I'm going to sit down with advice, here's the best way for me to position it because I know it will resonate for them here, as opposed to just throwing me data, getting a blank stare, whatnot. But if you give me data, if you give me a story, a visual, then I can make the connection and have that aha moment because you're mapping it out in my mind here. So let's invite you to make it part of your long-term process here. So here's one example. I'm going to show you a few examples here. It's using the visuals. Now, if we take a step back here, if we look at the last 10 years prior to 2022, and even during COVID in 2020, for the most part, since after the financial crisis, for most investors, and this is not to discredit the work that you, that's not what I'm suggesting. For most people, what they understood, making money was easy. Investing was easy. Why? Because their experience with the market since 2010, 11 has been nothing but this, upwards. And I know this because in speaking with some of you, Angelo, this is 4 or 5 years ago, having a tough time telling my clients, things will go down. Clients say, yeah, we know it's going to go down, but it'll come back up here. But, so for most people prior to 2022, right, investing was easy. Yes, we take some tweaks and we have to make some changes, but, it's pretty much a linear path here, right or left, but you keep going forward, easy peasy. With the experience and all the people you work with, no, that's not real life. Real life is this. When it comes to financial planning, with all your concerns, all your objectives, your desires, your situation, your financial situation, these things called life and market, everything is just one big mess. And as an advisor shared with me, she says, Angelo, this is what I tell my clients when they ask me what I do. My job is to help you demystify all that noise that's out there so that you really know how it applies to you and what's important to you. That's the value of what you bring. And by the way, if you want more of these visuals that like this one here, notice on the bottom left-hand side of the screen, you see behaviorgap.com. You can go to that website, call Richards, also known as the Sketch Guy. I think you can purchase some of these, but make sure if you're going to share anything with clients, it meets your compliance department approval. But I think this is a great example that explains what you do and really showing it to prospective clients or reminding clients everything you've done for them, sharing the story. Recall back during the last financial crisis, this was a concern. Here's how we got you out of this, how we managed that, and so on. And folks, let's face it, over the last couple of years, now more than ever, your advice is required and even more valuable than ever, because we've done some number of studies and research is out there from Sun Life Global Investments and Sun Life that shows most Canadians, those that work with advisors, will say they've got better investing habits. They're 2 times as likely to have at least 1 year's worth of expenses. And, 8 out of 10 practice saying they have a better sense of a positive sense of what's helping in their financial health and well-being, also helping with their physical, mental health and well-being. You're removing the stress. Think of everything you've done over the last couple of years, and certainly in 2020 through the global health pandemic when it hit. You were of service, you have presence, despite the fact that you have to look after your own health and your business and your family here. How do we share this? How do we remind them of all this? How do we put this out there? Well, here's a great resource made available to you from Sun Life Global Investments. I strongly encourage you to reach out to your local regional wealth sales director, to get in touch with them, to sit down, book a one-on-one meeting or a virtual meeting, say, hey, saw this presentation on behavior-focused advice or some resources. Angelo said we can reach out to you. They will sit down and meet with you, show you how you can use it. Why not use something like this? You've got a website. Maybe you have a Facebook page for business. Maybe you have a LinkedIn profile. Why not educate the public, your clients? It's a reminder. This is why you've come to work with me. This is why people decide to work with me and my team and so on, however you like to phrase it. Drip, get the message out there, reminding them, prospective clients that are looking for advisors or get referrals, what do? They will go do a search for you and see you on your Facebook or website or LinkedIn, and they'll be seeing some of these articles like this. So you're taking control of that message and that narrative, dripping on that. Again, find different ways to use it in your marketing activities. I know many of you have a process. When we sit down, if I'm a prospective client, I'm sitting in front of you virtually or in person, you're going to explain to me, what the process is, how we work together. You might be telling me, again, am I going to hear everything you say? Am I going to retain it? Why not combine what you say with a visual or an exercise? This is about mapping out the process to the client conversation. You have your own way of doing this. I'm pretty sure you understand this visual, right? When you're meeting with prospective clients, or as a reminder to existing clients, the process that you're doing. And folks, we do all this, but then there's something called life and market events. I kind of get in the way and trip things up here. And that's where, as you know, dear client, what we've been doing over the last 20 years, or dear prospective client, rest assured, this is why we're still there. This is what so it's not just about when you sign the documentation and go, no, this is where our advice and our stewardship role continues and goes further and further. And these are the things we do. I'm not going to labor this point because I know you've got your own folks, but here's a visual. Find your own way to do this. Now, I'm going to sidetrack here a little bit, okay? This is something that we're talking about, managing your client's behavior, prospective client's behavior. But think of it. What are you also doing? This, to me, in my mind, is a great visual snapshot created in your own way, shape, or form to help your clients explain to friends or family. Do you know what they're saying about you when you're not in the room? When they finish a meeting with you, can they explain to their friends, their family network, what you do, how you do it, and who you do it for? I think this could be used in a different variation as a great tool. Those of you that work with centers of influence, lawyers, accountants, and whatnot, would this not be a great snapshot to say, hey, if you're trying to explain to your clients, your business owners, professional, what we do, here's something that could help you in your own language or whatnot. So again, visuals, right? Storytelling here, data, anecdotal data. Do it in your own way, shape, or forms or whatnot, okay? So I noticed here, Kamlesh, you put a comment in that. Yeah, you just say to them, that's great, but please tell me if you get heart attack. So exactly, right? It's a lot of it is about emotions here. And I will say this, I will be blunt about this, okay? I mean, think about it. Do people come to you to buy a product, an insurance, a seg fund, an investment, a mutual fund? No, they're coming to buy your mission, your vision. They're coming to buy you. They want to buy an emotion. Yes, there's the cognitive analytical aspect, but it's really that emotion that makes the connection here. There's another great visual from behaviorgap.com. To me, it speaks volumes. It just shows that, reminding them that you are probably the only individual that will prevent them from making the big mistake here. And so to me, that speaks volumes. Think of the work of you do. How many other professions are out there that can really, really have such a positive influence and impact on people's lives? And I know some of you say, well, Angelo, we kind of, brain surgeons and heart surgeons and firemen and police officers. Yeah, I get that. I'm not diminishing their work here. But think of what you do. You know this. How do we convey that? So make it part of your process. Prospective clients, existing clients, communications, find different ways through your social media, through your marketing, through your virtual and in-person meetings to drive home the message and drip on them here. Oh, sorry about this. There's something else you could do to continue driving home the message here is how do you educate and engage clients? I know many of you will do webinars or seminars as part of your communications plan, as part of your touch points and your marketing plan. Great ideas, taxes, financial planning, estate planning, the benefits of using seg funds, perhaps from SLGI, whatever the situation may be here. I would say take a step further. Why not do something and say, hey, you know what, dear clients, I've received many questions, over the last couple of months and whatnot. And many of you have expressed, gratitude, they're present for you. Just thought I'd like to share this thing about, by the way, we've interesting research that shows, it's not just what you do, it's how you behave that can have a serious impact on your financial health and well-being. Folks, it's just a way to get in front of your clients. It's a touch point, right? It's a way for them, it's a way for you to say, hey, why don't you bring that golfing buddy of yours, Robert? Why don't you bring your coworker, Susan, that you spoke to me about? It allows them to bring people in a non-threatening way. What I'm nudging at is growing your business, referrals. I know I'm stating the obvious, but there's the reason for doing some of these activities. By the way, this is 30, 40-minute webinar. You want to do that, we've got a white label version of this, or if you want, we can come in and share with you. Sit down, reach out to your wealth sales director. We'll be more than happy. Again, it's a way to differentiate yourself, and it's a way that you're not just about products and solutions. You're more than that, and showing it to them. And they can say, hey, come join me this evening. I'm going to a webinar here. It's from whatever, 4:30 to 5. I'll show you what my advisor does and not out there selling to me and so on here. Okay. So I think I said enough on this portion of the session here. I see the time is moving forward. We've looked at, why people behave the way they do and understand that. We looked at one way to manage it over the long term is to find ways to continuously communicate the value of your advice, the why, reminding them why they came to work with you in the first place here. That this short-term noise doesn't have any impact on that. The next thing we can look at here is the third takeaway for you is, okay, how do we overcome some of these investor behaviors and biases in the short term? And this kind of quick hits, you get that phone call, clients in a panic to sell, or that email or wants to buy certain stocks and so on here. How do we manage it? So this is going to be some quick hits for you. And what I'm going to do here is two things, right? And again, I don't see any questions there. Thank you, Kamlesh, for your comment there. I appreciate that. So I'll keep going forward. What we'll do is this. I'm going to share with you three investor types that are pretty familiar to you. What I will do is go through some of their characteristics, look at their profile and whatnot. And I encourage you and invite you, as I go through each one, jot down the name of a couple of your clients, just 2 or 3 clients. be it pen to paper, phone, whatever you do, jot down the name. Because as I go through this, I guarantee you will be thinking about some of the people you will have met or worked with over the last few years. And the next thing we'll do is once we've gone through those profiles, we'll attach to them a process. What do we do? And this is really the key principles that we want to keep in mind when helping clients overcome their biases. One is to understand the root cause of the problem. What's the issue here? Because ultimately what you want to do is connect their finances and their emotions. Again, remember, it's always about not just the what you want or what's the issue, but why do you want it? That's the accountability factor we need to get down to. Step 2 is reframing the conversation in a positive manner, right? You share stories, reminding them of things you did for them, what you've done for others in similar situations. To then 3, redirect them onto the right path, bring them back to specific discipline, actionable items. Step 2. Okay, so let's go with the first one here. What we call the slow and steady advisor here. So to me, this is really someone who's so focused all about preserving wealth and really wants guarantees and looking for investments with guarantees, and more guarantees, right? It's all about the fear of losing money. And so in some cases, they prefer to avoid taking decisions because there's the risk I can make a bad one and create a loss for myself. There are some of these individuals that will sell their investments for fear of losing more. Example, I can share many examples, but I've seen people speaking with their advisor, even acquaintances of mine come to me like I'm going to give them a miracle response and say, telling me that they had a great strategy, that they got out of the market because they got their statements, and statement season is upon us, folks, so get ready. They're saying, I saw some gains and I wanted to preserve those gains, so I sold my investments because there's going to be a better time to go back into the market. Okay, so that's when you want to laugh and say, so you did this without even thinking about all the tax implications for the non-registered investments. And how do you know when to get back into the market? Because if you've got some secret sauce there, I'd like to find out about this and get some skin in the game here, folks. So this is what you need to understand. So think some of your clients or prospective clients that you met. And this is why the primary bias type we say with these individuals is loss aversion, where the fear of losing money is so significant. In fact, psychology tells us that when there's a negative, is twice as strong the psychological impact. And that's what we're showing here on the right-hand side of the screen, as you can see. So for the same number, right, one's freeing the loss versus gain, 2 times more impact in terms of, the emotional stress that it will cause here. So again, when you're looking at these people, understand in your communications, it's all about how do you preserve their money? How do you remove that fear? If they're panicking about markets, finding ways to put loss in perspective. And I got a couple of resources I'm going to share in a couple of moments. I would even say practice the fire drill approach. What do I mean by that? Well, if you've been in buildings or recall back in school, in high school or grade school, we always did the fire drill. And the purpose of that was what? To make sure in the event of an actual fire, nobody was running around in total chaos. You knew where to go, hopefully in an orderly fashion. You knew where to be so things could be managed and get you from point A to point B in the event of a fire. It's the same thing with a portfolio, client or prospective client. Ask them the question, dear client, today your portfolio is worth $250,000. You wake up tomorrow morning, it's worth $200,000. What will you do? What will your intentions be? How are you going to behave and act? Now, you never know the full response, the full reaction. But if you see a hesitation, that gives you a sign possibly that, they don't know exactly what to do, or the advice I've given them hasn't registered. If you see them responding in a proficient manner, calm, well, that gives you a sense that, okay, maybe it made sense. And, there are people that are not going to panic. It's just a way to gauge to find out what they might do and see an instinctive reaction or response, help you gauge how to better provide advice here. Here's another great resource from Sun Life Global Investments that'll help you put loss in perspectives here. And what you see on the screen here, this is data of the S&P 500 ending December 31st, 2021. So hopefully we'll be updating this in the next few weeks and months to get 2022. But what you see is performance here for the last 42 years up until December 31st, 2021, the market. So this is all the blue bars here. And what you see at the bottom, these diamonds here, is every year we're showing, regardless of whether the year finished in a positive or negative territory, every single year, dear client, this was the worst decline that you have. Every year, there was a point where the market was in negative territory. Yet only 9 of those 42 years did the markets end in negative performance. Of course, if this was doing 2022, we'd say 10 of the last 43 years. But you see where I'm going here. You don't see this, dear client, but the market, even in great look at these years here, right? Back in the mid 90s, all positive calendar years, but there were negative returns at some point. The market dropped. You don't see that, dear client. Maybe you could look at a different way of putting perspective. Here's another great resource, okay? And this is market declines, but we're going through different periods. So maybe I'll go more recent here for depending on the clients you work with, right? If you're dealing with a boomer and a Gen Xer, look at Black Monday, look at the dot-com bubble, maybe the financial crisis. What does this show you? So it's showing you the duration. These are the numbers of that negative period of the cycle of the market. So you see this here, the red line. But then the blue line is 1 year after. The green line is 5 years after. And the purple line is 10 years. So dear client, listen. So reminding them, recall what we did when we were in that period. These are the things we did. So it's a way of putting it in perspective. Either as we did in the previous slide, you don't see what's happening, but they still ended up being, positive. And only 9 of 40 years was a negative. Here, it's showing perhaps a little bit longer cycle that ties into their retirement period and so on. So yes, you can have access to these resources. As I said, reach out to your wealth sales director at Sunlight Global Investments. They'll be more than happy to share some of these resources with you in a one-on-one meeting, virtual or in person. To those clients that say they know when to invest, they know when there's a better time to invest in the market. Here's another clear example. The S&P 500, your $10,000 investment, what would have been worth 20 years later had you stayed invested? Well, worth a little over 60, just under 62,000. But what would have happened if you missed the 10 best, apologies, folks, the 10 best days, the 20 best days, the 30 best days? I mean, face it. Your clients take vacations 10, 20, 30 years. They're not paying attention to what's happening. But look, we're talking about we're 7,500 days, whatever the number is, a fraction of a percentage point. And look at the impact it can have on your financial health and well-being. So here's another example that you can use just to remind the client they're acting on emotions. Let me get to the second one here because I see the clock moving forward here. I want to make sure there's a couple of minutes left for Q&A at the end. Fear missing out investor, the FOMO investor. And this is really pretty straightforward. Think of that client. So think of your clients. Jot down a couple names. The ones that call you, why aren't we in cannabis stocks? We should be doing crypto. We should be doing biotech. We should be doing Nike, whatever. We should be buying Apple. That one investor that's always listening to the noise that's out there and trying to chase the fad here, okay? And really not recognizing that they're creating undue risk in their portfolio because you've already, in tandem with them, built a well-diversified portfolio. It's because they're so focused on hearing all the noise. Short-term thinking, it could be recency bias, which is a little bit cognitive, but primarily a herding bias. Herding bias is that fear of not, following the herd. And I say that, and I'm sure you have an image in your mind of sheep, right? Just head down and everyone following what the sheep at the front of the pack is doing here. So undue risk within their portfolios. They're just listening to others and all that short-term noise. So your work here is to try and change their mindset. That shifts them from a thinking fast to a thinking slow. And by that, I mean from going to a knee-jerk reaction to investment decisions to purposeful consideration of alternative options and choices that are out there, which could simply mean their existing strategies about it. So this is the work that you need to make doing here, reminding them that there's things that they cannot control. The hidden reality, of course, the harsh reality, I would say, is that in our industry, everybody focuses on return. We can't control those returns. What we can control is the time, when to invest or to start investing today and staying invested, the risk profile that we have and related to the portfolio, what we want to, and how we behave. So here's one strategy that you can do. If they believe in following the herd and listening to what others say, take advantage of this bias and flip it 180 and offer them social proof. And this is where the value of story sharing comes in. And I know you're good at doing this, right? Sit down and say, hey, this is what we did with clients that had similar concerns or similar family situations such as yours. It maps out a picture. It rings a bell. It makes me realize, aha, you're doing this with people similar to me. Stress level goes down. Share some examples. Hey, many of our clients have not successfully used this approach. It's almost become a standard way to tackle this issue here. It's always reassuring me that you're already doing this, because when we're faced with something that we're afraid of, or it's the first time we don't know how to handle, we automatically assume it's just us. Nobody's going through this. Now you are normalizing this behavior and saying, yeah, it happens with others. And guess what? I'm here. That's what I've done. I'm here to do the same thing with you. Kind of like going to visit to their doctor, right? It's not just about bad news. Sometimes it's a lot of it is good news. Or how do we take a bad situation? I'm here to guide you through this process and bring it into good situation. So reminding these individuals that are chasing the herd, listen, and I know you've seen this document in various forms, different presentations here. So, reach out to your Sun Life Global Investments Wealth Sales Director to get a copy of this diversification diagram. But all it really we're telling people is this, folks, and certainly those chasing the herd. Look, folks, we don't know that today's winners will be tomorrow's winners. I mean, if you look back for a number of years, okay, growth U.S. equities are kind of cheating the system here. They outperformed. But, and who knew? Who knew that in 2022, the bond markets and the equity markets would wake up one day and say, you know what, there hasn't been enough chaos in the world and people's lives with this global health pandemic. We need to have some fun again and really scare the bejesus out of people here. And both of these, the asset classes went up to hell in a handbasket here. So we just don't know, hence the importance of a diversified portfolio. I know you say this. I know you talk about this. Give me a visual. Give me a story. Tap into the cognitive and both emotional side of the brain. That will give you a sense how to best deal with me and go forward here. And I want to get into the last profile that we said here. Again, think of some clients, 2 or 3 clients that in this case act as the know-it-all investor. You know that client of yours or the prospective client that you've met that has had some success in one sphere of their life. Maybe they've been a successful business owner or successful in a certain career that they've had or a project leader. They are convinced that if they've had success there, I simply take this process, bring it to investments, and I'm going to do well. That's their perception. And that's what these people end up doing. They are afflicted what we call the overconfidence bias, right? They are overestimating their capabilities and just assuming that this is no different from anything else they've tackled here, right? So they won't always follow your advice. They want to blame you for some mistakes, but they don't, when they make mistakes, they won't come out and openly admit to them here. So they might want to do excessive trading in the portfolio. These are also people that come with their own research and information to confirm, look, what I'm saying is right. So they might be afflicted with confirmation bias, right? Getting the resource and information that proves a perspective, but a lot of it has to do with a primarily emotional bias, what we call overconfidence bias. So again, it's really about the tendency for people to overestimate their abilities. How do we manage this? How do we do this? Well, I mean, it takes some time and effort here. It's really about having the conversation, helping them evaluate the consequences. If you're going down this path, this is what the impact could be here on this situation or that situation here. Kind of making sure they're aware of all the scenarios. In some cases, some advisors said, you know what? I tell the clients clear cut. Listen, if you're coming to work with us, this is how we work. This portfolio is to fund, is the source for those retirement dreams you have, is the source for that house payment, is the source to pay for, you see where I'm going. This is the foundation of all the things you want to do. You want to have fun and go into cannabis or think you can outperform, take a small percentage of the portfolio, go open up an account on your own, go have some fun. We've labeled it Mad Money account, label it however you will, go and have some fun. You won't tell them. You know that this client will come back and rub it in your face if they think they've outperformed you, but they will never admit to underperforming you and making mistakes here. We all saw the TikTokers going online telling people in 2020 and early 21 how they beat and did great. Funny, we didn't see people being so gung-ho in 2021 having to deal with the volatility of markets and getting, smacked across the head and all the tech stocks underperformed and whatnot here. So, one thing you can do is revert them or refer them back to the investment policy statement. So check with your dealer. They may have some documents. Check with some of your providers. They may have some templates. You could build one in conjunction with a client. And folks, in an IPS is really, the business plan to a business owner, right? It's the financial plan to financial plan. This is that financial plan, the business plan for the investment portfolio. And, I've had the privilege of working in private wealth management in the past, and you come across some clients that are working with in private wealth management, and it's really about the IPS is what provides the guidelines. What are the objectives? Okay. What are the parameters? What's the asset mix? Is there any frequency of rebalancing here? The frequency of meetings, what type of, so again, it's kind of the business plan or the financial plan for the investment portfolio. It talks about rebalancing. It allows you to bring the clients back to that. When they're asking questions, why have we done this? Why is that there? I recall when I was in private wealth, I'd bring the IPS back to the client and say, okay, you're asking why we have all this fixed income within your registered accounts. Well, asset allocation target is 60-40 and in equity. And we said, look, you can see here, right? We want to do efficient investing. So we want to maximize as much of the fixed income within your registered accounts, or your RRSP at the time, or your pension plan. And the clients would stop me and say, oh yeah, I realize that my registered assets, are smaller than my non-reg. So all of it is going to be fixed income. Okay, Angelo, I recall, I get it. It's just little checks and balances that we need to do here. So an IPS could be a great document. Here's another resource. I think this is self-explanatory. It's just a reminder, if you're going to be super active, you're going to be missing out opportunities. Your retirement is in 20, 30 years, okay? Your legacy is hopefully as long as possible. Let's look at these things on a long-term basis, excuse me, that we can do that. So, some of these things that I've shared with you, I know many of you are doing. Some of you are new to the industry of the last couple of years, and this is the first time you had to go with this. I know you all have your own process. Hopefully, I've impressed upon you the importance of having, visuals, stories, using data. What are other people doing there? And there was an interesting study done from the Investment and Wealth Institute that wanted to hear from advisors and say, what are your risk mitigation techniques to help manage clients' behavior when volatile markets come about? And again, this was done in 2019, before this whole pandemic and market volatility. So they were given a list of options, and they just tick off the different options that they use. And I just wanted to share the top 4 responses here. So what you could see, most advisors said, like you, they're trying to make sure, using some of the resources and the tactics that I just shared with you, to make sure the clients are focused on the long-term view. They're also trying to do systematic processes, and that's interesting. What could that be? That could be, maybe systematic rebalancing, depending on the client, automatic investment, your dollars cost averaging plans. It could be systematic, consistent meetings, respecting the process, dear client. This is why we need to have an annual review. This is why we need to have one in person, maybe one virtual, right? It's about automating the process, staying in touch. I love this whole integrating goals-based investing. This is what I touched upon earlier. Reminding the clients of why they came to you in the first place. You said you wanted to do this so that you'll be thrilled and happy to see your kids go to post-secondary studies. Look at the root cause, tie their emotion to the finances, remind them, this is what you came to me for, and this is what you agreed upon. What has changed? You'll see the conversation may come back and say, okay, yeah, but that gives you a sense of how to better manage that. And of course, as I tried to show you, looking at uncovering the emotional triggers. Okay, we're talking about biases. Before I wrap things up, though, there's something that we need to be aware of. It's not just our clients. We're humans too, as advisors, right? The human advantage. We're not robots. We all have blind spots. We all need to check in with ourselves. And so that Investment and Wealth Institute research paper also asked advisors, here's a list of biases. Check off the ones that you think you see within yourself. And what was interesting, the top 2 most popular responses were loss aversion and overconfidence. And I can understand that, particularly loss aversion. You are dealing with people's wealth, their future, their life, right? And you don't want to blow things up here. The overconfidence doesn't surprise me also, because oftentimes, and I've had many advisors, it's not just me, many advisors come back and say, yes, sometimes, things are easy that I even overestimate that things are going to happen a certain way. So it's just about, listen, this is not a critique. It's just an observation. Say, understand, what are some of your own biases? Do they affect how you manage your clients? Do they affect sometimes in the advice that you're giving, which is great, unbiased advice? Just be aware of that. That is all I'm saying. If it's more cognitive, if it's more emotional, and how you share your information, folks. Okay. Again, it's about managing that behavior. So to wrap things up, let's go back here and check in. We looked at 3 things. 1, it was all about understanding this behavior gap. Why do clients behave the way they do? And it's really about understanding how the brain works. It's the fight or flight and how the biases affect the way we process information. The second point was the key to communicating your human advantage. And this is about having a process that allows you to drip and remind clients, prospective clients, the value of everything you have done for them and will continue to do for them. And the third part is all about, looking at some of your clients, seeing what type of profiles they are, identifying their biases. And I shared some quick hits, some resources for you to go ahead and actually, do this for yourself and manage with your clients here and whatnot. So again, some biases and so on here. Why you want to do this? why you should be looking at this. I mean, aside from the short-term benefits, obviously about, keeping clients invested. For me, that third and fourth bullet point are key. It's really about going above and beyond the KYC. I know we'll never truly understand our clients, but you will definitely get a better sense. You will get to know them. It shows the individual, the human, not just the financial planner or the investment advisor. You really take some time to differentiate yourself. To say, no, the purpose of this meeting is not to go and do an insurance sale. The purpose is we need to understand that there's a good fit. I really understand what the root cause of these problems are with your client. So it's about strengthening that relationships and, increasing the retention and the ties, and people talking about you saying, this is what my advisor does. They're not selling my advisors, got the best insurance product, the best seg fund. No, they're talking about the value of everything they do here. So I see a number of you are also, asking me some questions or what kind of questions you're asking to check with yourself here. If some of you, follow Canadian Securities Institute, I know there's a very interesting course. I did that a few years ago that talks about biases, and you can access some resources that have many different questions, things that you can do. In the world of the psychology, there's some, 200, 300, 400 biases. When it comes to investments, that's narrowed down to about maybe 15, 20 types of biases, both cognitive and emotional. And so, there's plenty of white papers out there, like I said, from Daniel Kahneman, Richard Thaler, that talk about investors' behavior, and they'll explain to you the different type of biases. So like I shared with you, once you see the different type of biases, you can see how some of your clients exhibit those biases. Think of your clients that are, herders and chase after the hot fat. Think of the clients that are all about simply looking at protecting money. So that'll tell you right away there's loss aversion here, and going from there. But yeah, the CSI offers a good course on that, on behavioral finance. And I think the Financial Planning Institute of Canada has some course that's offered on, human-based advice, and a focus on also understanding biases and the different context of biases and the different stages of the financial planning process. So hopefully, James and Ifkar, I've answered that question there. So my ask of you is this. I invite you to do this before we wrap this up. Look at the meetings you'll be doing. You'll be meeting people for RSP deposits, maybe TFSA contributions, things of that nature. Right? Take a moment. Who are the ones that you're meeting? What profile do they exhibit? What biases do they exhibit? And step two is, how can you prepare perhaps having conversations? They are getting statements. They're going to see negative returns. How do we address that? How do we put things in context? Use some of the resources that I shared with you, right? Knee-jerk thinking fast to thinking slow, understanding the consequence. We've given you enough resources there. Hey, why not perhaps at some point in Q3, maybe in March, prepare your calendar, book a webinar. Hey, clients, we're just going to do an information session, have some guest speakers here, how your behavior can have a significant impact and will help you avoid financial pitfalls. So that's just something you can reach out to your wealth sales director at Sun Life Global Investments, have that conversation with them. They will sit down with you and show you those resources and how you can use them. And maybe if the right conditions are there, even support with you and work with you to help you deliver that information webinar virtually or in a seminar format. So that is it for me, folks. I thank you very much for your attention. We're coming up right up a minute to 2 o'clock. So hopefully we spent the last 55 minutes were extremely valuable for you. I see a question, can we get copies of these slides? We don't, from Sun Life Consulting, share our presentation deck and slides. I know there's been a recording of it from Lisa and IDC, so you might be able to view that. But if you reach out to your wealth sales director at Sun Life Global Investments, they'll give you a one-pager summary of all the detailed points, the key points of this presentation as well.